Okay, so good morning, everyone. I'd like to express my sincere gratitude to all of you for participating in this course. So today trainings focus on the 2025 International Annual Financial Reporting Updates and will run approximately 2 hours. We are honored to have Ms. Eunice as our presenter for these sessions. Before we begin, I kindly ask everyone to update your username to your real name and to turn on your video camera. This will help to ensure more effective training sessions. So now please join me in welcome Ms. Eunice. Thank you.
Thank you. Thank you. Okay, you hear well. All right. Good morning, everyone. A Happy New Year. Okay, since this is the first time I meet you all of you in 2025. Okay, so wow, I saw so many people. Hello, hello. It's good to see the face of people, especially in webinar, because we are not face to face. So it's good to see your face so that I know that I'm talking to someone rather than talking to a camera. All right. Thank you very much. Let me do a little bit of my here. Okay, fine. Now let's start. Okay. A little bit background on myself so that you know who you are talking to. I am Eunice Ju. I'm a CPA in Hong Kong. I started my career in Pricewaterhouse, and then after that I am the audit manager for a number of years. Then I venture out in the commercial field. I spend most of the time in Sony Music, Sony, and as the regional finance director. And I'm in charge of the Asia Pacific region for the financial reporting and also management reporting. Then after some time, I joined ACCA. So I have working in ACCA for 7 years as head of policy as in Hong Kong. All the years I've been involved in training, financial reporting training. I train students taking professional exam, ACCA exam, Hong Kong ICP exam to pass the exam paper. But apart from the exam focus, I also do a lot of the industry training, like providing CPT, Certified Public Account. CPT means CPT hours, all right? Continue professional development hours. So I'm very honored to be invited to the speaker today of University of Mansfield. And today we are going to talk about the 2025 International Financial Reporting Updates. Okay, now before we start, just let you know that our section is 2 hours long, and you have to completely stay in these 2 hours before you can be awarded a CPT hour certificate after the completion. During these 2 hours, we have discussion, we have polling questions that you need to participate. So please pay attention to all the content of these 2 hours. Now, today, because it's annual financial reporting update, we will do a number of updates, not just one standard. So because we have to cover 6 standards, all right, 6 topics within 2 hours, we don't go into very in depth, all right? We don't go into very deep for each accounting standard. We just understand the concept. So in case you need to learn more about the accounting standard, you have to go into the relevant webinar training and also the material to study it, all right? I think that the first 2 standard is most relevant to you, all right, as a subsidiary in Cambodia. And the rest of the 3 and 4 is relatively less important, but at least you need to know. But the 5 and the 5th and the 6th standard is relating to auditing rather than financial reporting. But I also want to touch on them to let you understand what they are about. Okay, whether they are relevant to you, you will judge by yourself whether it is relevant to your work or not. Now, we look at this timeline. All right, on the left is the financial reporting standard that are effective by December 2024. So on the left, we have the classification of liability and also the interpretation of whether it's current or non-current. Now, this is actually all international, and also those highlight in red are the topic we are going to cover today. On the right is the accounting standard that will be effective in coming years? I would say out of the 4, we will cover 3 of them today. The first one, which is actually a very important accounting standard, IFRS 18, we need more time because it is about the profit and loss account. Okay, every company has profit and loss account, so it's very important and very big, but we need more time. Therefore, I don't cover this time. Instead, we'll cover, well, all the topic highlight in red today. All right? So now, the first topic is the classification and measurement of Hong Kong FRS 9, the financial instrument. Okay, this actually affects your closing, your book, you do accounting and all that is very important to your financial reporting. So let's take a look. What are the changes? What are the changes? On the left, it said that the recognition of financial liability, that is most important. All right, that is most important because they talk about on which day we should de-recognize a financial asset and financial liability. Well, what is meant by de-recognize? De-recognize means disposal, write off, all right, take it away, remove from the ledger. That is de-recognize. So by when we would de-recognize the liability, financial liability. Now, normally you own, for example, you own somebody some money, accounts payable. When you de-recognize it, of course, when you make payment, when you make payment to settle the liability, you will de-recognize it, right? It's very common sense. But now there are some changes. The timing of de-recognize a financial liability, especially is related to electronic transfer. Electronic transfer means you are not paid by check. You make an electronic transfer through bank or through a number of payment gateway like PayPal or FPS, PayMe, or in your country, other method that you pay maybe through the phone, you make payments. So that is we talk about, we'll go into detail what is meant by de-recognized financial liability. All right. Secondly, is the focus about, okay, ESG linked features financial instrument. You may heard about that more and more companies now invest in green bonds. Green bonds means financial instruments that are ESG related. So how we should classify this type of financial instrument when they have a ESG linked features? What is about it? Is it SPPI? So what is SPPI? We'll go into it. And third one is the non-recourse loan and also the linked instrument. So how should we classify non-recourse loan? Okay, it will be also relevant to you. This part is most important. All right. And okay, this account standard is actually effective in the beginning of 26. All right, 1st January 26. That means next year you use it. But this year you have to collect comparative figures, right? So I would suggest that you also need to know now, so that if you can practice now, it's better. You can adopt it now, it's better. Because next year, when it's effective, you already doing it, you can have comparative figure. So now, let's look at the timeline first, all right? Day 1 and day 3. Now, what is mean about day 1 and day 3? It's like that. When you make a payment to your supplier, you write a check, right? You make a payment on day 1. So the payer initiate payment is day 1. Then you take the check to the supplier, right? You give them the check, and they will take the check to bank into the bank, right? But the check will not be cashed out immediately. Okay, so when you take the check to the supplier in day 2, the supplier get the check in day 2 and take it to the bank. But the check will not be used immediately because they need time to cash out. So by the time of day 3, the payee, that means the supplier, receive cash in the bank. Understand? So that is the settlement day. In other words, the supplier can use the cash on day 3, in day 1, because day 1 is the one you write the check. You deliver the check to them. Even they got the check on day 1, they cannot use the cash. They have to put into the bank and clear it. So day 3, they can get the settlement. All right, understand? So that is a payment day and a settlement day. Now, my question is, I have a polling question. Okay, polling question. Number 1, when should I de-recognize account receivable? When? Okay, when should I de-recognize account receivable? Okay, launch. You have to choose. So account receivable means I have a AR, account receivable, and I get payment, I get cash check from the supplier. from the customer. When I get the cash from supplier, from the customer, when I get the check from the customer, when I get the check from supplier or customer, okay, I get the check today. Should I derecognize the account receivable on day 1 or day 3? Make a guess. Okay, when I get the check today, should I debit bank and credit AR today, or I wait until my check cash out in the bank, then I can debit bank and credit AR? This is my question. Understand? When should I derecognize? That means remove the account receivable. Okay, and recognize yes. That means when should I debit cash and credit or debit bank or credit account receivable? Day 1 or day 3? Should I immediately do it when I get the check, or I wait until the money bank in? All right. So now, okay, I end the polling. You see, end the polling. You see, majority of you say day 1. Actually, I also chose day 1. I think, when I get the check, it is actually very clear that I get the money, so I will put in the ledger debit bank credit AR, right? So, did I share out you? Right? Okay. The correct answer is actually B. Majority of us are wrong. Actually, it should be day 3. Okay, so now another question. Okay, another question. If I make a payment to the supplier, I draw a check today, should I derecognize the accounts payable in day 1 or day 3? That means when the manager or my boss sign the check, the accountant will credit bank and debit AR, or will not. I mail the check and I wait until the supplier get the check, bank in, and when my bank money is transferred out, then I make the payment and I make the entry, credit bank and debit AR, day 1 or day 3. Should I put the entry when my manager sign the check and mail it out, or I have to wait until the supplier get the check, deposit into the bank, cash out, then I make the transaction? Majority of you now, okay, we have how many people here? We have 40 people here. So 43 people here. Try to participate. All right, try to participate. Just make a guess. I don't see who make so don't be embarrassed. I don't see who make the choice. All right, I only see the percentage. Only the percentage of the people. Okay, when do we derecognize account payable and derecognize cash? That means credit cash, debit AR. When I do it, should day 1 when we make the check, or until the supply bank in? Okay, I end the polling. I share the result. Majority of say day 1. All right, and I also make the same choice, day 1. But the correct answer is day 3. All right, so let's take a look. Okay, that is day 3. Most of the answer is day 3. That means these 2 entries, debit bank, credit AR, or debit AP, credit bank, all this happen in day 3. According to accounting standard, we should not derecognize the account receivable or payable until the bank really got the money or pay out the money. All right, surprising, right? I am very surprised, especially the polling question 2. All right, when I make check, I will immediately on the right-hand side, credit bank, debit AP. But now we cannot. We have to wait until the supplier get the check and deposit in the bank and cash out. So what happens if they don't cash out because the check is lost in transit? All right, or they are holiday. They did not, even they get the check, they didn't bank in. I have to wait, all right, until they do it. Now, I know it is very surprised. I know, okay? Let me explain. And I also will provide you a solution, how we'll change it. Now, some people say, Eunice, doesn't matter. Day 1, day 3, only 2 days different. All right, very short period, no problem. Well, in most of the cases, it is okay. In most of cases, no problem. Because day 1, day 3, if they are in the same month, doesn't matter because we close the book on a month basis. So it should be okay. However, if day 2 is year end, in between day 1 and day 2, that's a year end, then there's a problem. Because as a year end, we have to comply with we have to comply with the account standard, and the accounting standard tell us that we cannot derecognize on the right hand side, derecognize our AP or derecognize our AR until the cash is really cashed out through the bank. All right, there's one exception, except it is made through electronic payment system, EPS. Then, if the EPS takes 3 days, then we can derecognize the AP on the day 1 if it is made through electronic payment. Now, let me explain. All right, let me explain. Now, this is actually a new update. The story is like that. First of all, a person, okay, let me show you first. First of all, a person found that, their company, sometimes in the past, we do traditional way. We write a check to settle the AP, right? But now, no, we don't do it. We do electronic payment system on the top, EPS. So EPS, they find that when make the EPS, they press a button, all right? They do it electronic payment through the bank. They press a button, and it takes 3 days. The other party will got the money, all right? It takes 3 days. The other party will got the money. So that person doesn't know, oh, if I make an electronic payment, should I derecognize the AP, accounts payable, in day 1 or day 3? So this person raised a question to the International Accounting Standard Board, IASB. Then IASB investigate. Then they make a judgment. They said that, hey, recognition, there's no change for financial asset or financial liability on the right. Okay, we are on line by line. For recognition, when will we recognize financial asset and financial liability is on the day on which the company become a party to a contractual provision of an instrument. Now, if you don't understand the English, doesn't matter. It just means that when you a financial asset or financial liability is a contract between two parties. All right, I have an AP, you have an AR. All right, when I have a loans receivable, you have a loan payable. So financial asset liability is a contract with two parties. Okay, one receivable, one payable. One financial asset, the other is financial liability or equity. Okay, so when we recognize financial asset liability is when a company become a party of this agreement, this contract. When you become one of the two parties of this contract, then you should recognize financial asset and financial liability. So imagine if you deliver goods to your customer, then you have a right to receive money, right? So you can recognize account receivable and sales. The other party, when they get the goods, they have a payable to you, all right? Then they have a contract because they have they get your product, they have a payable to you, then they have to recognize purchase and also a financial liability. So there's no change in terms of the recognition. However, in the derecognition, here are the changes. The IASB concluded that for account financial asset, by when you don't have the right, contractual right to cash flow expire. All right, only when the right to receive cash flow expire, then you can derecognize the financial asset, which is day 3. It means that if the customer gives you a check, but there's no money in the bank. Even you receive the check, you bank in, the check will bounce. The check will bounce. You know what's bounce? That means not honor. You still have the right to chase them, right? As long as you haven't got the money, you still have a right to chase them. Therefore, you shouldn't derecognize the account receivable until you really get money into the bank. Understand what they say? Therefore, even you get a check from the customer, you shouldn't derecognize your accounting receivable until you make sure that the check can be cashed out, can be honored, and cashed in your bank. Fair enough, right? Therefore, you should not derecognize your account receivable until the cash is banked into your bank. So that's day 3. All right, so that's 3. Okay, now we look at financial liability on the right-hand side. All right, on the right-hand side, right-hand corner. Now, same as liability. When you should derecognize the financial, not the right hand side, on the middle column. When you settle a liability, is only when the obligation to pay is discharged. So even you draw a check to the supplier, the check may bounce, right? If the check is lost in transit, mail deliver or fail deliver to the supplier, okay? The supplier cannot get cash. As long as they don't get cash, as a company, you still own their money. The obligation is not discharged. Therefore, the Financial Accounting Board say that you can only derecognize the liability when the cash really go into the supplier. All right? Even you write a check, the check can be lost in transit. Therefore, your liability is still not extinguished, means it's not removed. You still own them until the money is going to the bank. All right? So that is the conclusion. There's one exception on the right. There's one exception that you can derecognize the liability in day one. All right? Which is electronic payment. Because electronic payment, you press a button, the money will go definitely. The money will not be lost in transit. In that case, if you satisfy some criteria, then you can derecognize the liability, which are settled by EPS on day one. All right? In other words, creditors receive notification that a debtor has submitted payment instruction. The creditors does not get practical ability to the cash. All right, they still cannot have the ability to use the cash. Therefore, you still own their money. All right, understand? So what is EBS? They said derecognize by liability and settle in cash using electronic payment. In case you settle a liability through EBS, right? Then you are allowed to derecognize the liability earlier on day one. All right, but you have to satisfy that the company has no practical ability to withdraw. That means once you press the button, the money will go. You cannot stop it. And the company cannot take the cash out and use for other purpose. You cannot. Once you press the button, the money will go to the supplier. Okay? The risk associated with electronic payment is insignificant. It means that the money, once you press the button, there's no risk. The money will definitely go to the supplier. In that case, you can derecognize the liability of day one. Otherwise, you have to wait until the money really go into the bank of the supplier. Understand? All right? So if a company can elect, all right, even if in some cases, if you use some electronic payment, but okay, if a company select to use electronic payment, then all the settlement made through the electronic payment has to settle in the same way. Okay. Okay, now I know some questions, so later on, let me finish this first. Now, for what is meant by insignificant risk is that you follow administration process. In other words, the time between the make payment and the cash really delivered to the counterparty is very short. It's very short. There's no chances that your company can take out the money to withdraw the money or stop payment. So that means insignificant risk. However, if the completion of payment is subject to whether the entity has ability to deliver cash on the settlement day, the settlement risk is still not insignificant. What does it mean? It means that have you made TT payment to the bank? You may actually have that experience, right? You fill out a form, or I make TT payment to your overseas supplier, right? When you fill out the form, sorry, you cannot derecognize the AP, because when you fill out the form, it only means that you notify the bank that you are going to make the payment. However, the bank will only make the payment when there are enough cash, enough money in the bank account. If there is not enough money in the bank account, the bank will not make the transfer. Right, electronic transfer. Therefore, you cannot derecognize the AP on that day. You can only derecognize the AP on day 3. All right. So that is the difficult part or the change part. Okay. Now, so what we mean that is deem that financial liability is discharged before the settlement day apply only to those settled in EPS. It means that all financial liability can only be derecognized on day 3, except those financial liability that's settled by EPS. all right, with insignificant risk, then you can derecognize on day one. Got me? Okay. But this practice does not apply to financial asset, does not apply to financial asset. In other words, for financial asset, for account receivable, you have to wait until the money got into your bank, then you can derecognize the financial asset. All right. And this accounting policy is not available for other mode of settlement, such as check or credit card. In other words, EPS, you can derecognize on day one, but all other mode of settlement, like check or credit card, you can only derecognize on day three. Understand? Actually, this change is quite big, all right? It means that for account receivable, you can only clear the account receivable when cash hit the bank account. And for check payment, you can, even you write the check out, you cannot derecognize the account receivable. You have to wait until the check clear. In other words, there's no more bank rec. In the bank recon station, there's no more unpresented check. Understand me? Because all the check has to be presented before you credit bank and debit AP. All right? So isn't it crazy? Now, I would suggest this. After I teach this, everybody say, oh, how can we do it? Hang on. I would suggest you do whatever you are doing right now. You continue doing whatever you do right now. But as a year end, you do a unpresented checklist. You check how many checks I issue out, which are not yet present in the bank. And those unpresented checks, you reverse it. You debit bank and credit AP. Okay, those unpresented check, you cannot credit bank. You have to debit bank and credit AP, put it back into the bank, and you cannot derecognize AP. Understand? So this part is most important. And this actually poses some challenges for intergroup balance elimination in consolidation. Okay, because for like account receivable or payable, some people may only derecognize, especially the payer is using EPS. They settle by EPS and derecognize the AP on day one. But for the receiver cannot derecognize the AR until they get the money. So there will be a gap. So that will pose some challenge in consolidation. All right? Any question on this? That is part one. Now, let me take a look at the question. I know that it's very difficult. Now, some people ask me, Du Shuk Leung asked me, how about EPS with a scheduled day pay on in day one, but schedule the day settlement day three, they recognize day three? Yes, of course. If the EPS you schedule on another day, for example, you use the EPS today, but you schedule the payment make on next Monday. All right, the customer will only, the supplier will only got next Wednesday. All right, you schedule the payment on next Monday by EPS, you can recognize the AP on Monday, but the supplier will got the money on Wednesday. So you don't need to wait until the supplier to get the money before you derecognize AP. Only when you settle by EPS. But if it is check, you cannot. If it's check or credit card, you cannot. You have to wait until the supplier get the money in the bank, then you can derecognize the AP. All right? I hope I answered you. If you schedule a day, of course, you derecognize the AP on the scheduled day. Not today, not the make the payment day. Is the scheduled day. All right? Okay, good. I answer your question. Now this I know is most important to you, therefore I explain it more slowly. Okay? Okay, now we change another subject. That one finished. Change another subject. Now this one is more difficult. Remember that when we classify a financial asset, we have this classification. We look at whether the financial asset is SPPI. Okay? SPPI. SPPI means we need to contractually receive cash, all right? And if it is we have a correct contractual cash flow, then it is SP. And the contractual cash flow is SPPI, solely payment of principal plus interest, then it's amortized cost. However, if you aim at collect the contractual cash flow and sell the financial asset, and the contractual cash flow is SPPI, then we can measure the financial asset at fair value for OCI. All right. The other is fair value through P&L, we can say designated. Remember, we talked about this before, but for those who don't remember, doesn't matter. Let us revisit. For financial asset, we classify it into 3 categories. For those who have collect contractual cash flow, that means under the contract, I have a very clear known cash flow. I know how much cash I can collect it back. For example, I make a sales or product to the customer. I know how much I can collect from the customer. And the collection of the cash flow is solely payment of interest and principal, SPVI, then I should recognize them at amortized cost. All other cases, I can recognize them at fair value through P&L or fair value OCI. Now, today, I would like to focus on amortized cost. All right, let's look at what is amortized cost. Financial asset stay at amortized cost means that the financial asset will give you a specified date of cash flow. Okay, imagine you make a loan payment, you extend a loan to a person, and the loan will be repaid over 3 years. You know which day you will get back the principal, you know which day you can get back the cash. Therefore, it is an amortized cost financial asset. And give you an example is account receivable. So in that case, for account receivable, you make a product. You send a product to the customer, you know how much amount you will get back in 3 months' time, say for example, plus 2% interest if they delay payment. So that is amortized cost. And for amortized cost, we have to measure the account receivable using effective interest rate. Okay, and recognize income when calculating and recognize the interest income in the P&L. Now, what is meant by effective interest? Effective interest, we talked about this before, is equal to initial amount plus interest less repayment equal to amortized cost. Now, if you don't understand, you can imagine you make a product and send to the customer. You charge them 1,000. That is the initial amount. But they delay payment. They delay, all right? You only give them 1 month credit, but they delay. Therefore, you charge them 2% interest. So you get $1,020. You have a $1,020 receivable from them. But then they make partial settlement to you, all right? They make 500 settlement to you. 1,000, they give you back 500 only. So the amortized cost equal to the 500 plus the $20 interest. Right? So that is amortized cost, which equal to the initial amount you charge them, plus the interest, if any. Sometimes it can be 0, minus whatever they repay. Sometimes can be 0. If they never repay you, then the total amortized cost will be equal to 1,000 plus 20. Right? So that is meant by amortized cost. Now, let's do an exercise to refresh your mind what is meant by amortized cost. Say, for example, this company buy a 100,000 long stock. Long stock means an investment. They buy a investment, all right? Long stock. They sell 100,000. The interest rate is 6%. However, they don't need to pay 100,000. They get some discount. They only need to pay 93930. All right? So they got a discount, all right? But at the end of the year, they can get back, all right, get back 100,000. In other words, they already make some profit or some interest, okay? Around 6,000 interest, around 6,000 something interest on that. Apart from that 6,000 discount, every year they also get 6% coupon rate, which means they got 6% on the 100,000 as interest. Now, interest will be received at December each year, and the long stock will be redeemed at 2027. That means how many years? You buy on 23, all right, January 23, full year 23, 24, 25, 27, 4 years. So in other words, you invest, all right, 93,000 in the 1st January 23 and get back 100,000. You get back 100,000 in 4 years' time, all right? Now, the effective interest rate is actually 7.5%. Now, people ask me, why 7.5%, not 6%? No, because you got discount, remember? So 6% is on every year interest. But apart from this 6%, you get additional 6,000 as interest. That 6,000 equal to 1.5 interest. All right, 1.5% interest, effective interest. So how to do this? So when we do this, we just say, okay, the account entry is on the 1st January, you debit financial asset 93, credit cash 93. Every year, you got 6,000 interest. Remember, 100,000 times 6%. So you debit cash and credit the financial asset. Okay? Credit financial asset, not credit financial, not interest income. No, not interest income. Hang on. So in the year 4, you will get the 100,000 back and you can clear out the financial asset. All right. So that is the cash flow. Now, how much interest I earn? The interest is like that. You cash out 93, you will cash in 6,000 every year for 4 years. And then last year, upon maturity, you got 100,000 back. So actually, the cash is like that. The movement of the financial assets like that. At the beginning, you have 93,000, all right, in that financial asset. Every year, you accrue 7.5% on the 93,000. So it should be 7,064. Every year, you get back cash, 6,000. This 6,000 is to deduct the financial asset. So at the end of the 1st year, the balance of the financial asset is 94. All right, 94,000. That is called amortized cost. Why amortized cost? You invest 93. All right, you should get back 7,000. That is your interest, but you only get back 6. So at the end of the year, it is 94. Got me? All right, you invest 93. Initial amount plus interest. The interest should be 7%, not 7,000, not 6,000. The 6,000 is cash flow. You receive 6,000. And then at the end of the year, that is amortized cost. Got it? All right. So this is the interest income recognized in the P&L, not the 6,000. The 6,000 is a cash flow to reduce the accounting asset. So now we understand the liability. All right. At amortized cost. Now, another exercise, financial liability at amortized cost. This time, the company borrow 1 million at 8%. Borrow 1 million at 8%. And the effective interest rate is 14% per year. Okay? So it means that although they pay out 8%, the market interest rate is actually 14%. Therefore, the loan stock is deemed like that. Okay, now you borrow 1 million. This is the interest expense. Okay, okay. The loan stock is redeemed at par on 2025. What does it mean? It means that you issue a loan stock, 1 million. You take it out. Hey, I have 1 million loan stock. I will give 8% to you. An investor will say, hey, if I invest elsewhere, I can get 14%. Your stock is only 8%. I don't want to buy it. So what you can do is, please buy it. All right. What you can do is discount. All right. You don't need to pay me 1 million. How much you only need to pay me? You only need to, present value of the future cash flow. You tell the others that every year you pay them 80,000, all right, for 3 years. And then at the end of the 3 years, you will pay them 1 million. Then a rational investor will only give you 860,000 today because 860,000 is the present value of the future cash flow. All right. So you see that, okay, now I invest, if the investor give you 860,000 today, every year they got a 14% interest, then you repay them $80. So at the end of the year, the amortized cost is 901. So next year, the same, and the 4th year, and the 3rd year, then you can pay up to 1 million. So what I want to show you is amortized costs is look at the initial amount plus interest minus the repayment. Initial amount is actually a book value. We don't look at the fair value in the market. So, okay, so that is called amortized cost. Now, why we talk about amortized cost? What is the change? The exchange is like that. Account center said, if a financial instrument meet the amortized cost, meet the SPPI test, solely payment of interest plus principal interest, then it should be measured amortized cost. Otherwise, you should measure a fair value, either through P&L or through OCI. Okay? And when we look at what is meant by SPPI, solely payment of principal plus interest, they said that we have to look at whether it is basic lending arrangement. What's basic lending arrangement? You also in your country, you have basic lending arrangement, right? You borrow a loan, you pay interest. And the interest is actually a time value of money, which will reflect the credit risk, okay? Most significant element of interest. What do you mean by credit risk? Now, imagine if you are the bank, you will some people come to ask you for money. You lend money to Apple, a big company, right? Apple, the Apple iPhone. That company asks you to borrow money from you, or another small company. Which company you want to lend money to? You want to lend money to Apple, right? Because it's a big company. Their credit risk is lower. They will not default you. They will not run away. They will definitely repay you the amount. That is meant by default credit risk. In that case, you will say, oh, if you are Apple, I charge you a lower interest rate, 5%. But if you are a small company, the credit risk is high. Therefore, I will ask a very high, all right, interest rate. Understand? So therefore, interest rate is actually a time value of money, reflecting credit risk and also liquidity risk and also administration costs. It can add a profit margin. What does it mean by liquidity risk? It means that if I lend the money to you for 10 years, the money is tied up. I cannot use the money for a long time, right? But if I only lend you for 1 year, wow, it's more liquid. All right, I can get the money very soon. So that is liquid risk. So therefore, if the asset is liquid, then I can get back the money very soon. Therefore, I can charge you a lower interest rate because I get back the money very soon. But if you ask me to lend you for 10 years, oh, I have to wait until a long time. Then I have to reflect that maybe I worry. During these 10 years, you will default me. You will run away. Therefore, I will charge you a higher interest. Got me? So it is telling you that interest rate is actually a basic what is meant by basic lending arrangement is interest rate that reflect this. Now, why we talk about SPPI, it is, let me give you an example, or let me give you a test. Can you let me know whether this is SPPI? Okay, a company buy green bonds, 4%, green bond 4%. Now, if the company fail to reduce gas emission, then they have to pay 5%. Wow. All right. Now they pay 4%. But if they fail the carbon emission reduction, they have to pay 5%. That means 1% penalty. 1% penalty for failing the carbon emission. Actually, the market interest rate without this ESG linkage is 4.1%. Now, can you tell me, is this... Okay, let me show the polling question. Where's the polling? Okay. Is this arrangement an SPPI? No. Without, I normally pay 4%, but I fail the emission, I pay 5%. So is it a time value of money, credit risk, or liquidity risk? Yes, it is SPPI, or no, because it's contingent upon meeting the emission target, right? So no, it is actually not, or it depends. So what is the answer? Okay, so now I have ended the question where most of you have participated. Please, quicker. All right, so those who want to participate, I don't see who participate, but try. We have 60 people, 61 people here, so more people is better. So, okay, now the answer, okay, majority of you are correct. Okay, the answer is it depends. Now, why? In the past, without the change, people will choose B. No, because you pay 4%, but suddenly you pay 5%. And that 1% is on carbon emission, which is not interest. It is not time value of money, it's not credit risk. Therefore, many people raise the question, if I invest in these ESG related bonds, should it be a amortized cost? Should I classify it amortized cost? Is this SPPI? Then IASB come up with this decision. They said that if the contingent event, you have to look at whether the contingent event give rise to SPPI. All right? Do the contingent event give rise to cash SPPI? If the contingent event does not give to SPPI on top, it failed the SPPI test. When you fail the SPPI test, it has to stay at fair value. Okay? But both before and after the contingency. If you say yes, even I fail the emission, I still pay 5%, which is still interest, then you have to ask yourself whether the contingent event is a change in basic lending right. All right. If you check yes, it is change in basic lending right. Okay. Where it is related directly to a change in basic lending right. In that case, 1% is still a lending interest, then yes, it will meet the SBPI. If you say no, it is not a change in basic lending right, then you have to see that whether it is significant different, all right, whether the instrument is identified or identical, that means similar to financial instrument without such contingent feature. That means with or without such contingent feature, it is still the same. If yes, they are not significant different, they are the same, then they meet the SBPI criteria. Then in that case, they can continue to be classified as amortized cost. Otherwise, they cannot. All right? Now, if you don't understand the chart, don't worry. Let me explain it again in words. It means that, first of all, you have to assess number one, you have to assess the contractual cash flow before and after the contingent event. Remember, in that case, what is the contingent event? Meet the emission target. If you meet it, you can pay 4% interest. If you fail, you pay 5% interest. All right. So that is the before and after. Before 4%, after 5%. Okay. And if this 4% or 5%, are they consistent with basic lending right? Okay, are they consistent? Remember, it is still interest. And if they are, contractual cash flow would not be significant difference from financial instrument without such contractual terms. If yes, then it is SPPR. It means that although I pay 1% more, but still within the market range, it's similar to, I borrow from another company, all right? Then it is actually consistent with other borrowing without the ESG target. Even without the ESG, I just make a simple borrow. I still pay 5% or 4.5%. So in that case, it satisfies the SPPI test that you can classify them as amortized costs. All right. But if you say no, actually the cash flow is fluctuating, then it is not. Now, if you don't understand, let me give you questions. No example. All right. Test whether who will be know this. All right. Polling question 4. Okay, tell me, which of the below situation is SPPI? First, if a debtor meets X number of repayment in financial instrument, remember, if you make borrowing from the company, like mortgage loan, you have to pay every month. Sometimes a borrower, they miss 3 months. Then the bank is so angry, say, okay, if you miss 3 months, I will increase your rent, increase your interest. Fair enough. If the company missed 3 months repayment, the credit risk increase. So the bank worry, therefore they charge a high interest, right? Now, another example is if the interest is actually fluctuate depending on the index. For example, the stock market index, Hang Seng index, or Dow Jones index. All right. If the interest rate go up when the Dow Jones index go up, if the interest rate go down when the Dow Jones index go down, is this basic lending right? All right. So my question is, which of these two scenarios meet the SPPI test? Okay. One is when they borrow a missed payment, that means the credit risk increase. When the credit risk increase, the bank worry, therefore they charge a high interest. Fair enough. This is basic lending right. But if the interest rate go up and down with the Dow Jones index or the stock market index, this is not basic lending right? This is actually investment related interest. In that case, I'm sorry. Okay, polling, difficult, right? Share the result. Actually, the answer is A. All right? The answer is A. The answer is A. Majority of you are correct. You can understand that when I already tell you that when okay, the answer is A. When the the debtor miss settlement, that means the credit risk go up. Therefore, the interest rate go up. Such is related to credit risk. So it's basic lending right. But if the interest go up and down, depending on index, that is not. All right. Another question. Instrument X is a borrowing. Adjust every reporting period by a fixed number of basic lending right. Okay, this is related to the carbon emission. If you are able to reduce carbon emission, my interest rate will go down a little bit. However, look at the second paragraph. The adjustment will not significantly change the interest rate. In other words, the reduction is very minor. The reduction is very minor. Okay, if you are able to meet the, okay, let me go to question 5. Okay, so is this SPPI? Remember, they said if you are able to meet the carbon emission, then I will reduce your interest. Okay, so carbon emission actually is something not related to credit risk, not. However, the adjustment is very minor. The adjustment will not significantly change the interest. All right, so is this SPPI? Can this meet the SPPI test? Let me guess. Okay, when majority of you try it, I will stop. All right, so please, when those who want to try, quicker. Ready? Okay, quick. I have to stop. Otherwise, we don't have enough time. Okay, majority of you are correct. Okay, the correct answer is actually A. Now, right, the reason is because the not, I see the not, right, in yellow, because it doesn't change the interest rate a lot. That means the adjustment is very minor. Even after this transaction, remember just now you say, before or after, the cash flow is still SPPI, then it is satisfying the SPPI test. All right. But if you say that no, the adjustment is very significant, then no, you will fail. All right. Understand? So because of the not, the yellow word, therefore the answer is yes. Otherwise, it will be no. All right. Okay. The last question. If instrument Y is a loan with interest rate that adjusts with the carbon price index. Okay. Now the interest is adjusted with index. Is this a Okay, let me launch the polling question. Which one is correct? Does it meet the SPPI test? Remember, when the interest rate fluctuate depending on index, all right? Is it a basic lending right? Okay, if it is fluctuate depending on, for example, exchange rate, all right? US dollar to Cambodia dollar. Okay, so is it the interest rate if the interest rate go up and down depending on the exchange rate, then in that case, is the interest rate basic lending right? Is it only consists of credit risk, liquidity risk, profit margin? No, absolutely correct, right? If you have listened, you just said no, understand that when interest rate is benchmarked to index, then it is not SPPI. It is not SPPI. Only when interest rate is not benchmarked to index, there can be a contingent event, but the contingent event will not significantly adjust the interest rate. That means not adjust the time value of money. Then it can still satisfy the SPPI test. Then the financial instrument can still be amortized the cost. All right. So that is the new change. Not really new changes, but actually a clarification regarding the ESG related investment. Okay, the last point is very interesting. Okay, is a financial asset with non-recourse features. What does it mean by non-recourse features? Now imagine a bank now give a loan to company entity X. This entity A used the money to construct a building. Look at the picture on the right. It's a commercial building, very pretty, right? So the entity A tell the bank, I will repay you the loan plus an interest. Good, fair enough. It is SPPI, right? Over 10 years, fine. The loan with 5% interest for 10 years, that's fine. However, it is only limited to the rental income earned from letting out the commercial interest. In other words, if the rental income is very good, I will pay you the principal plus 5% interest. But if the rental is very bad, no one rent the lease, I'm sorry, I cannot pay you. The maximum I can pay you is the rent. There's a cap. The amount of money the bank can get is the maximum. It can be either the interest, the rental income generated from the building. Okay. My question is, in that case, the bank does not have a resources to other assets of company A. In other words, the bank cannot say, oh, company, even the rental is not good, you have to repay me the principal plus interest. No, the bank can only get the money from the rental of the building, not from outside the resources of the company A. That means I cannot say, company A, you have to pay me from your sales, from your profit. You cannot. The amount the bank can get is from the rental income. Okay? Non-recourse features means the bank does not have the ability to demand entity A to repay me beyond the rental income. All right, you cannot, if the rental income is zero, I cannot ask the company A to pay me from their profit. I can only require the company A to pay me from the rental income. Got me? That is called non-recourse feature. Now, my question is, if you are the bank, can you classify this loan as SPPI? Can you classify this loan as SPPI? Remember what's SPPI? SPPI means solely payment plus interest. Okay? Yes or no? May I guess? At this time, I want to achieve 60% participation. Can you help me? Okay, more people participate than will. Is this SPPI? The bank get back principal plus interest? The maximum amount the only source of income or the source of repayment is the interest. Okay, very good. This time we have 56%. Share the result. The answer is B. All right, so majority of you are correct. All right, majority of you are correct. Oh, my circle doesn't go to B. The answer is B. All right, no. Okay, this is not SPPI. Why? Because non-recourse provision does not itself to stop you from SPPI. However, the accounting standard requires the bank to look at the yellow number, look through to the underlying asset. Actually, the bank has no ability to get back principal plus interest. Or put this way, the bank actually is investing in the building, in the commercial building, and investing in the rental income. The bank is actually investing in the rental income. Only they structure it in a way as repayment of principal plus interest, right? Because the bank is actually exposed to the risks of the property not able to rent out, not able to lease out the rental income. Therefore, the cash flow actually may not meet the SPPI test. Understand? So if your company give a loan to the others, and the others will repay you the principal plus interest. However, there is such non-recourse provision. The borrower say, hey, I will only repay you the loan from the income generated by this machine. If this machine does not generate enough income, I'm sorry, I'm not able to repay the loan. Even the borrower can make very good profit elsewhere. They are not required to repay you. Then in that case, the lender, the bank is actually investing in the machine, investing in the building, the rental income of the building, or the profit of the machine. Therefore, the loan cannot be classified as SPPI, and the loan cannot be amortized cost. Understand? Okay, now, people ask me, Eunice, what is the difference between non-recourse loan or collateralized loan? Do you know what's collateralized? Collateralized means you give an asset to the borrower. In case you default, the borrower can use the asset and sell it to repay the loan. All right, that means to pledge loan. Now, I'll give you an example. Look at here. David bought an apartment and borrowed a mortgage loan from the bank. All right? And the mortgage loan is actually secured by the apartment. You understand this? So in case David default and not able to repay the bank can take his apartment, sell it in the market, and then repay the loan. If there is still balance, they will repay back to David. Now, the bank will say, all right, David, you have to repay me the loan. Now, David also promised David will pay off the loan by the rental income of the apartment. But apart from the rental income, David also need to, to pay the bank from his salary. So in case the apartment cannot be rented out, David has to use his salary. Maybe he will ask his mother, father, his parent to give the money to repay the bank. The bank say, you have to repay the loan. I don't care how you get the money. You can get back the money from the rental of the apartment, from your own salary, from your daddy, mommy. I don't care. As long as you repay me the loan plus interest. Okay? In case you default, I will take your apartment and sell you in the market. All right? So David's loan is a collateral or a non-recourse loan. The bank say, I don't care how you get the money. All right? I don't care how you get the money, as long as you repay me the money. You can repay from the rental of the apartment. You can pay from your salary. You can pay from your daddy, mommy's money. All right, but you have to pay me. If you fail to pay me, I will take your asset, take the collateralized asset and sell in the market. So this is a collateralized loan or non-recourse loan. Okay, majority of you are correct. Very good. So we cannot face too long, all right? So try to participate. Okay, share the result. Correct, the answer is A. Because the bank doesn't limit its repayment to the rental of the apartment, right? So look at another case, you will be clearer. Okay, company XXX borrow a loan from the bank and use the money to construct a tunnel. And the tunnel is used to secure, all right, the loan. And they pay principal plus 6% interest, but it's limited to the cash flow generated by the toll fee. You know what's toll fee from the tunnel? When you drive through the tunnel, you have to pay the tunnel fee, right? So the XXX company say, okay, I will repay to you the loan from the toll fee. All right. If the toll fee is bad, I'm sorry, bank, I cannot repay you that much. I am not obliged to use my other asset, all right, other profit from the other asset to pay the loan. So this type of loan is, okay, this time, XXX corporate loan is a collateralized loan or non-recourse loan. This time, the limited to cash flow generated by the toll fee. This is a, they will not say, the bank will not say, okay, I don't care you get the money, toll fee or from your other asset, you have to repay me. No, bank, you cannot do that. You can only rely on the cash flow from the toll fee. In that case, this is a very good, very clever. This time you learn it. Okay, majority of you are correct. 90% are correct. This is non-recourse loan. In that case, the bank cannot classify this as SPPI, and it cannot be amortized cost. It is actually the bank invested in the tunnel. Understand? So the bank can only classify this as a fair value financial asset and not amortize the cost, because the account standard require the bank to look through, remember? To look through the transaction. Got me? Understand? So this is the two very different concept. Okay, we finish up with the FRS 9, which is more relevant to you, so I spend more time. So the rest of them are much easier. All right? Got it? So another standard which is still relevant to you is subsidiary without public accountability. It's actually a very small account. This is a new account standard, but very small. It's about disclosure only. All right, so it's very simple. Now, first of all, may I ask you, there are how many sets of financial reporting framework internationally? How many? 2, 3, 4? Make a guess. How many sets of international financial reporting standard? 2, 3, or 4? I don't count your own accounting standard, all right? I'm talking about international accounting standard, all right? I don't count, there's a Cambodia financial reporting standard. So I don't count the Cambodia first, all right? Let's look at international. How many sets of international financial reporting standard? International. Okay. Okay, very good. Good try. The answer is 2, all right, for international. Of course, if you count national, there are many, like China accounting standard, Cambodia accounting standard, Australia accounting standard, Japan, wow, many, right? But I'm not talking about national accounting standard, only international accounting, there are 2. One is the International Financial Reporting Standard. Another is International Financial Reporting Standard for SME, small SME, all right, small and medium-sized medium-sized entity. Sometimes we call it SME FRS. All right, 2, international IFRS or SME FRS. Okay, 2. Now, why I talk this is according to international or all account standard, they said that if you have a group company, you have a parent, you have a subsidiary, the group, we need to use the uniform accounting policy, right? The parent and the subsidiary, both of them has to use the same accounting standard. All right, which is fair enough. However, when we come to a subsidiary, the subsidiary sometimes is very small, right? The parent is very big. The parent may be a listed company, but the subsidiary can be very, very small. So for the subsidiary, actually, they are permitted to use small SME financial SME standard, all right? FRS for SME or SME for PE, private entity, all right? So the subsidiary can use SME standard while the parent can use the full FRS. But by doing this, the subsidiary has to keep 2 sets of book. Why? Because if the subsidiary use SME standard, when they report to the parent, they have to report the full international IFRS. Okay? Otherwise, the parent, when they do consolidation, it is very difficult. They are not in the same accounting policy, right? So if the SME's own financial statement use SME, when they come to report to the parent, they have to use IFRS. That means the subsidiary has to use 2 sets of book. To avoid this problem, then the parent will force the subsidiary, hey, all subsidiary has to use full IFRS. Then you don't need to use 2 sets of book. Everybody use the same IFRS. However, by doing this, IFRS have many disclosure, a very extensive disclosure. In that case, the subsidiary is so small, they make so much disclosure. It's disproportionate to the information need to the user. Actually, the parent company doesn't need you to disclose so much. They know very well of the subsidiary, right? Therefore, these 2 problems, all right, the red and the blue, create a lot of noise, a lot of complaint in the market. The subsidiary has to use the international financial reporting standard in order to be consistent with the parent. However, they have a lot of disclosure. Therefore, the new accounting standard, IFRS 19, come out, is a solution. They said that, okay, I give you a solution. I allow you to make small, reduced disclosure. Therefore, FRS 19 is actually a reduced disclosure accounting standard. The effective date is 1st January 2027. Subsidiary may voluntarily select. That means as a subsidiary, when you prepare financial statement using the IFRS, you can select using IFRS 19. Or if you don't like, you can omit it, or you can forget it. All right? It's voluntary. You want to do it, you can do it. Now, what does it mean? It means that for recognition, measurement, and presentation, you still follow other accounting standards. Say, for example, you have property, plant, and equipment. You still follow IAS 16. All right? You still follow property, plant, and equipment. The recognition, the depreciation, everything the same. Only when come to the disclosure part, in the audited financial statement, you have fewer disclosure. All right. For example, the subsidiary has inventory. You still follow IS2, FIFO or weighted average. You follow everything the same. Only when it comes to disclosure, you can have reduced disclosure. All right. Now, sorry. Okay. Who can select or who can use this FRS 19? It must be a subsidiary. That means the company must be a subsidiary. It has a parent. And the company does not have public accountability. All right. What is meant by public accountability? And the second part we'll explain. And then the parent must have prepare financial statement that are available for public use that comply with IFRS. In other words, the parent will do a consolidated financial statement complying with IFRS. Not enough. This consolidated financial statement must be public use, available for public use. Available for public use means everybody can check it. In other words, it must be a listed company. Only listed company, the financial statement is made public. If it's a private company, the consolidated account and not making public, then the subsidiary cannot choose to use FRS 19. Understand? Now, what is meant by public accountability? They said that what is meant by public accountability means the debt or the equity instrument is traded in the public market. That means listed company. Listed company is public accountability, or you hold asset in a fiduciary capacity for outsider as a primary business. All right, which means you hold asset as a trust in trust of others. For example, David has a property, but David cannot use his own name to hold this property. They come to you and say, oh, can you use your name to hold the property? But actually property belongs to David. So you own this property, oh, this company is mine, but actually I'm not the real owner. I hold the property in trust of David. So one day when I sell the property, the money has to go to David. Now, this means you hold the asset in a fiduciary capacity on behalf of others. Now, if you have this type of public accountability, I'm sorry, you cannot use FRS 19. All right? So to conclude, only a subsidiary that have no public accountability and the parent will do a consolidated financial statement that are available for public use. In that case, the subsidiary can choose FRS 19. Now, give you an example. Now, the red, okay, that we have a parent, okay? On top, we have a parent. This parent is a listed company, so it has public accountability, all right? And it also do a consolidated account available for public use. Now, they have on the left, parent X. This parent X is a subsidiary of the ultimate parent. It's a blue color. Blue color means, okay, eligible for FRS 19 because it's no public accountability. This parent X on the left has two subsidiaries, A and B. A, no public accountability. Red is public accountability. And you also have a Y, all right, parent Y on the right-hand side with public accountability and subsidiary C and D. Now, my question is, I have a question for you. For the parent X means on the left, the blue one. Can it use FRS 19 in its own separate financial statement, in its consolidated financial statement, or both? Okay, both or either. That means both in its consolidated or its separate financial statement. So let me see whether you can. For parent X on the left, all right, for the parent X, can it use both or his own financial statement or separate financial statement? Remember, it doesn't have it is subsidiary by itself. It's a parent, it has a parent, and the parent will do a consolidation and it is available public use. So can parent X use FRS 19? Either in its own separate financial statement, its own financial statement, its consolidation of both or both. All right, or both. So make a guess. Make a guess, even you don't know. All right. Okay, I will add polling here. Sorry. Okay, share the result. Oh, the answer is C. The answer is C. All right. Both is its own financial statement or the consolidated financial statement, they can still use FRS 19. And this is very interesting because it says a subsidiary B, which is in red. Even it has a subsidiary B in red, it can, in this consolidated financial statement, they can still use 19, FRS 19, all right? However, if the top one, parent P, the financial statement is not available for public use, what happened? Then everybody cannot use 19. If the parent on top of that, its consolidated financial statement is not available for public use, then everybody here, no one can use 19. Understand? Because there is no consolidated financial statement available for public use. So if on the right-hand side, the consolidated financial statement is not available for public use, I'm sorry, whatever we talk about 19, forget it. 19 is not relevant to any company in this group. All right? Okay, so this is a very simple one. Just say that, well, when the recognition and measurement criteria is the same as FRS, IFRS, and SME. If they are the same, the disclosure will also be the same. So how do you determine the disclosure of the when applying S19? They said that if the SME financial statement and the full FRS statement is the same, then the disclosure will be following the simple version, which is the SME. If they are not, all right, then you follow FRS 19, the disclosure. Applying principle using develop the disclosure requirement is SME. In other words, the disclosure part is actually following SME. All right, the accounting recognition measurement is following full GAAP, but the disclosure part is simpler, following SME. All right, now this is some exception. All right, FRS 19 does not apply to operating segment, insurance contract, and earning per share. Okay, it does not apply to these three accounting standards. So if the subsidiary is applying this accounting standard, they cannot apply 19. And what is 19? Now, I am not going to go into the disclosure because it's many disclosure. Each section can be reduced. I just give you some example. For example, share-based payment. In the full GAAP, the disclosure requirement is 991 words. 991 words. But the disclosure for 19 is only 250. It is around 1/4 disclosure. All right? Like, for example, revenue from contract with customer. The full disclosure, the requirement is 1,600 words. The requirement, only the rules has 1,600 words. But if it is 19, that means half of the disclosure. The requirement is half of them. Just by judging from the words, there's already half. Therefore, the disclosure requirement under FRS 19 is much reduced. All right? And comply. Now, there's one more requirement in your accounting standard, accounting financial statement. You have to make an explicit and unreserved statement saying that the company is actually comply with FRS 19. All right? You have to stay in the financial statement that this subsidiary is complying with FRS 19. Therefore, the disclosure is much less. Okay? Understand? So good. We are good in time. All right. So now, by the way, since we only have 2 hours, there's no break. So we just go on very quickly. All right. We can finish up this. The next question is the classification of liability as current or non-current. So take a look. Under IS 1, all right, what is meant by current liability is the liability is settled in a normal operating cycle. That means AP. If the liability is settled in a normal operating cycle, then it's current liability. Secondly, is a liability held for trading purpose. Now, many people don't understand. For financial asset, it can be trading purpose. I buy the instrument, I buy the shares, I sell the shares for trading purpose. But for liability, they can also help for trading. But this only applies for some very large company like Apple. They have some issue debts in the public market, then they can trade. For majority of companies, we cannot. Liability cannot be trading, all right? Only very large corporate, like they issue bonds or debenture in the debt market, all right? then they get in the public market, then they can trade. All right. The third is liability that's settled within 12 months. Now, this means that sometimes you have very long-term borrowing. For example, 20 years mortgage loan. But still, there's 1 year, one part of it will be settled in the next 12 months. That part is current liability. Remember, we have current portion of long-term loan, right? Even the loan is long-term, but part of it, all right, can, for example, 10-year loan, but one out of 10 is repaid next year. That part will be classified as current liability. And there's one term saying that does not have contractual right to defer settlement. So if the company has a uncontractual right to defer settlement for at least 12 months, if you don't have the right, all right, that means I must repay in the next 12 months, then it is a current liability. However, if I have a I have a right to say when the lender knock at my door and demand me to repay, I say no, I can go away. I don't want to pay. If I have that right, it will be non-current asset. If I don't have such right, when people demand me to pay, I must pay, then I cannot classify them as non-current asset. I must classify them as current liability. Understand? So what is the change? The change is saying that, okay, now the amendment, they have a slight amendment. They said they does not have the right to defer settlement. They remove the unconditional, the word unconditional, they take it away, all right? They say that if a company does not have the right to defer settlement, defer means say no, in the next 12 months, then if I does not have this right, then I should classify the liability as current liability. All right, because when the other people demand me to repay, I have to repay. I have no choice. Therefore, it's current liability. Okay, so based on the right at the end of the reporting period, and the right there's an update saying that it's unaffected by compliance if the entity is required after the reporting period. Sometimes there's some compliance requirement, and as long as you can comply with the requirement at the reporting period, that means at year end, then you have that right. Then you can classify the liability as current. However, sometimes the compliance requirement may require you after the reporting date, then I can ignore the compliance requirement after reporting date. Now, I know you don't understand. Hang on. Let me finish. I'll give you an example, then you understand. All right? It is unaffected by expectation, whether it can meet the requirement or not. All right? Now, I know you don't understand this. So and the settlement, you can be settled by cash or equity or other asset. Now, for this 3 points, the top 3 points, I have clarification. Now, the fourth one is very simple. You can settle by cash, or you can even settle by your own equity. You can issue shares to settle the liability. All right. So let me clarify this 3 points by an example. For example, okay, the company is year 1. Now, December, year 1, I have a loan that will repay in year 6. That means 5 years time later. So normally it is a non-current liability because the loan will only repay in 5 years time. But the company has cash, has surplus cash. Therefore, they settle the loan in March, year 2. That means 2 months after the end, they settle the loan. All right. The financial instrument actually was signed in June, year 2. So let me ask you, how should you classify the loan? Current or non-current? Current or non-current? As at year end, you should classify current or non-current. The loan was settled 2 months, in 2 months' time. The loan is settled after year end 2 months. All right? But the loan is actually, by the term of the loan, it should be settled in year 5. Is current or non-current? Repeat. Now it's year end. The loan is to be settled in 5 years' time. I can settle in 5 years' time. However, I am cash rich. I just settle it 2 months after year end. So it should be current or non-current. Okay, don't look at the answer, just guess current or non-current. Okay, don't know, right? Okay, and Poland, share the result, 50-50. Not very sure, right? The answer is non-current. Why? By the time I issue the financial statement in June, the loan is already settled. However, they don't look at whether you settle or not. They look at whether you have the right not settle for the next 12 months. At year end, actually, I have the right not settle for 5 years. I only be required to settle in 5 years. I have the right, but I don't exercise the right, right? I'm cash rich, therefore I settle it earlier. I still have the right, right? Only I don't exercise the right. So therefore, it is non-current liability, even though the loan is settled right after year end. Okay, early settlement on 1st March year 2 can be disclosed as event after reporting period. Got me? So don't say that, oh, the loan has been settled, therefore it must be current liability. No, you look at the right. If the company has the right not settle, all right, after in the next 12 months, it is non-current liability. Got me? Another case. This time, the loan is repayable on demand. Repayable on demand. Again, same information. Year end, and then the loan is settled in 5 years time, but there is term saying repayable on demand. In other words, if the bank come to you and say, hey, I want you to repay, you have no choice. You have to repay it because it's repayable on demand. Well, although it say that it's 5 years, but during these 5 years, when the bank come to you and knock at the door, hey, I want you to repay, you have to repay. You don't have the right to say, I don't want to repay for the next 12 months. You can't, because there's some term saying repayable on demand. All right? During these 5 years, well, supposedly, if the bank don't come to you, it's fine. You only settle the loan in 5 years' time. But if the bank come to you and knock at the door, hey, repayable on demand, you have to repay. So is this a long-term non-current liability or current liability? Okay, now try it. Make a guess, even you don't know. Doesn't matter, even it's wrong. All right? Doesn't matter even it's wrong because you don't know, therefore we sit down to learn, right? So very good. Majority of you are correct. Okay, let me share to you. Oh, share the result. Oops, share the result. Okay, answer is A, current. Because as I say, you don't have the right, all right, to say no for repayment in the next 12 months. Therefore, it is repayable on demand, then it's current liability. All right, got it? So up till now, you should understand that it is actually a look at whether you have the right to defer settlement. That means not settle, refuse settlement for the next 12 months. If you have that right, then it is non-current. If you don't have that right, it is current liability. All right? So with these two exercises, you will be more easy to understand. Now, here, remember I tell you I will explain the point here. Now, the loan same information as a year end, repayable in 5 years' time. But you said the bank required the company to maintain debt to equity ratio, all right, to below 1. It means that if the shareholders fund is $1, the borrowing cannot exceed $1. It should be 0 point something. Understand? Debt to equity. It means that the equity, the shareholders fund is $10, then debt cannot be over $10. It must be $9 or below. All right? Otherwise, if you fail this, the loan become repayable on demand. Got me? All right. Now, the company failed. As a year end, the debt to equity ratio is 1 to 1.2. All right. That means the debt is 1.2, but the ratio, the equity is $1, the debt is 1.2. That means the shareholder $10, the debt is $12. All right, you fail. So the loan become repayable on demand. All right. However, the company obtained a letter, a waiver. Waiver means a letter from the bank. It's like, all right, although you fail the debt to equity ratio, I will not demand you to repay in the 12 months. You got the waiver. Good. You got the waiver. But you got it on the January 5th. You don't got it at year end. So my question is, will this be classified as current or non-current? Will this loan be classified as current or non-current? As at year end, you don't have this waiver. This waiver come next, 5 days after year end. As at year end, you fail the debt to equity ratio. Therefore, the loan is repayable on demand as at year end. I got the waiver, but the waiver is not as at year end. The waiver is next year. The waiver is only come in January. All right. Therefore, as at year end, December 31st, you don't have the waiver. Okay. So as at year end, do you have the right to refuse settlement for the next 12 months? Try it, please. All right. We have 60 people here. So ample length. Okay, very good. All right, the answer is current. All right, the answer is current because, all right, because the liability is actually you don't have the waiver. All right, as a year. Now this is different from US GAAP. US GAAP allow you to be non-current because as long as you got the waiver before you sign the account, it's still okay. But International Center is not like that. It's very strict. You must get the waiver before year. Okay. So the right to defer settlement must be, it can be subject to something, all right? Must have substance, must exceed at the year end. Remember, you have the waiver subject to year end, and you must be subject to specific condition. You can be subject to specific condition. As long as you satisfy the condition, then it is okay. You can still say that you have the right to settlement. What does it mean? Here, give you an example. Now, the company is year end, the loan is repayable in 5 years' time. Now, they require the working capital is 1. That means the current asset must exceed the current liability. And the testing day is December, March, June, and September. If failed, the loan will become repayable on demand. Now, the company is satisfied. The company is very, very smart. As at year end, the work, not satisfied, failed. Working capital is 0.9. That means the current asset is less than the current liability. All right? It's only 90% of current liability. So you fail. Now, they obtain a waiver from the bank for 3 years before year end, for 3 months. All right? They say that, okay, I will not demand you to repay for next 3 months. Now, this waiver is received before year end. Okay? So, but the company say, no worry, 3 months is good enough because by next test, all right, by March next year, I will be able to meet the requirement. Understand? Repeat. As at year end, as at December, the company failed the working capital requirement. But they know they can pass in March because they know the customer can settle and the business will recover in March. So the bank say, I will not demand you repay the loan for the next 3 months. And I will come to check you again in March to see whether you will meet the requirement. And the company say, no worry, by the time of March, I should be able to do it. So my question is, as at year end, should it be current or non-current? Remember, we say that as at year end, you have the right to defer settlement for next 12 months. Now you have the right to defer settlement for 3 months only. All right, for 3 months only. No, Eunice, the company say that by the time of March, they should pass it. Hey, you expect you can pass, but there's no guarantee, right? You expect something is irrelevant. Remember just now we say that. I know, remember the 2 points I say, I know you don't understand, but I am going to explain here. Your expectation is irrelevant. As long as at year end, you don't have a right to defer settlement for next 12 months, then it is current. So I already tell you the answer. What should be the answer? The liability should be current or non-current? Current or non-current? Okay. Okay, end question. So 50-50, that means you still don't exactly know. The answer is current. Why? Let me explain. Point 1, the company breached all right, the company failed the test, all right, failed the working capital requirement, failed. They got a waiver, but the waiver only 3 months. They only say that they won't demand you to settlement for 3 months, right? So it is no use. I need 12 months. Third point, I know the company say that by the time of March, they can pass the test, but the company's expectation is irrelevant. You only expect, but there's no guarantee you can pass the test, right? The conclusion is the company does not have the right to defer settlement for at least 12 months after the reporting period. Therefore, it is current liability. Understand? Now you understand that what it means by expectation is irrelevant. Okay? So now, another similar one. All right? Now, more difficult. The bank said, as at year end, the working capital has to be 1. That means the current asset exceeds the current liability. But at the next year, I give you a higher requirement. By the time of June next year, your working capital should be 1.1. That means the current asset should exceed the current liability by more than 1%, 10%. All right? Understand? So now they give you 2 hurdles, 2 requirements. Year 1, December, the working capital should be 1. That means current asset exceeds current liability. But next year, year 2, the working capital should well exceed the current liability, above 10%. All right? So 2 hurdles. Now, in year 1, the company is good, pass. They can got 1.05. That means the current asset slightly exceed the current liability. Bingo. But it is unsure whether they can satisfy the second bar. That means the first bar, okay. But the next bar, we don't know. But next bar, I don't need to satisfy today. I only need to satisfy next year. All right? So my question is, should this be current or non-current? Should this liability be current or non-current? Remember, the rule is very simple. As a year end, do you have the right to defer settlement for at least 12 months after the year end date? I have. All right? I already satisfied your requirement. But you are unsure whether you can satisfy. I'm unsure doesn't mean I can't, right? I cannot guarantee I will satisfy, but I at the same time I cannot guarantee that I can't satisfy. Its future is unknown. Future I can do better or worse. All right? Therefore, very good. You got it now. Very good. You have improvement. Okay. Share the result. The answer is correct. Non-current. Okay, non-current. Why? You satisfy the year-end requirement. You exceed the working capital over 1. Future 1.1, you don't know? We don't know that we don't know. We don't know whether we can satisfy or not. All right? So future requirement 1.1 does not affect whether the right exceed at year-end date, because the entity is only required to comply it next year. I don't need to comply it today. Today, I only required to make 1. I don't need to make 1.1, right? So a conclusion, I still have the right to settle, to defer settlement for 12 months as at year end. But you may argue, by the time of June, you may fail. Okay, by the time of June, if I fail, I can classify as current. But now today, I should classify as non-current. Understand me? Because today I satisfy. Future, if I cannot satisfy, I will reclassify it to current. Understand? So this is a very important topic. All right. Okay. Okay. We have okay. The next 3 is very, very simple. Okay. Supply finance arrangement. Now the story is like that. We have a supplier. All right. We have a supplier who supply goods to the buyer. Then the buyer should pay the supplier, right? The supplier say, okay, I give you 1 month credit period. But the buyer say, oh, I want to pay in 6 months' time. In 6 months' time. And the supplier say, no, if I cannot wait for so long. Therefore, the bank come in. So the bank will pay the supplier in 1 month, only in 30 days. So the supplier get the money to spend. But the buyer will only repay the bank in 6 months' time. Therefore, the bank is actually lending money to the buyer to settle the accounts payable earlier. All right, earlier. Understand? So the bank is actually this is called supplier finance. Understand me? Repeat. The supplier want settlement earlier, 1 month's time, but the buyer want to settle in 6 months' time. Therefore, the bank will come in, the bank will pay the supplier first in the first month, in the 1 month, and the buyer will settle the bank or repay the bank in month 6, all right, in 6 months' time. So, in other words, it's like that. In January, the supplier buy the goods, right? So you look at the table. At the January, the supplier has the accounts payable. In March, the bank settled the supplier. Therefore, in March, actually the company own to the bank and not own to the accounts payable, not own to the supplier. In June, the buyer settled the bank, therefore the full liability settled. Now people say, hey, Eunice, it's the same. January, I have 30,000 liability. March, I also have 30,000. Only the difference is in January, I own it to the supplier. In March, I own it to the bank. So it is the same. Yes, it is the same, but in total liability, right? But actually the gearing is different. If you own to the bank, the gearing is debt to equity ratio will be higher. Therefore, the account standard requires you that you should make the adjustment in March. You should remove the accounts payable and put it into a bank loan in March time. All right? So in January, you debit purchase credit payable. The account requirement require you March time, you should clear out the accounts payable and put it into the bank loan, because that will be showing the liability. And look at the middle. The name, this arrangement, we have 3 names. Some people call it supply finance arrangement. Some people call it payable finance. Some people call it reverse finance. All right, reverse financing arrangement. They are the same. Reverse factorizing arrangement. They are the same. So the definition is the bank will pay the supplier earlier, and the company will then pay the bank later. All right, so this is called supplier finance. And the effect is the company get extended payment term, the supplier get early settlement. Okay, so this is the effective date, will be January 24, 1. All right? And the disclosure, all right, here is about the disclosure of the supply finance. I'm going to go into detail, just let you know that this is the mean by supply finance, so that you don't miss it, all right? When you don't understand it, is you lost, you don't know what is, okay? Don't know what's mean by supply finance. All right. So I know it's not very important to you, but at least you know, oh, yeah, that is mean by supply finance. Okay, we still have 20 minutes before we end this call. We have 2 topics about audit standard. We will just on a board level to understand it. There's 2 accounting standard, which is not accounting standard, this auditing standard. All right, just let you know. One is IAS 570, is about going concern. Now, okay, the reason is now the economy is so bad. Many companies will collapse. As an auditor, we have to, when we issue the audit account, we prepare the books on a going concern basis. But now we have more concern that the company will collapse. Okay, material uncertainty regarding going concern sometimes may cast a significant doubt on the company's ability to operate as a going concern. And now this accounting standard change. Now, what is the change? They require us to increase the requirement to assess whether the company has going concern. It moved beyond inquiry and need a rigorous procedure. What does it mean? In the past, as an auditor, we just need to ask the management, how's the business? Will the company continue for the next 12 months? We just need to ask and then document and then prove is okay. But now, ask is not enough. Just discuss with the management is not enough. We have to do lower part. We have to evaluate whether the management is correct or not. Management's evaluation is correct or not. And most important is we shift the reporting day to approval day. And it covers 12 months post-approval period. In other words, it means that if you, in the past, as long as the company doesn't close down the next month from the year end, it's already going concern satisfied. If the company year end is 24 December, as long as the company lasts until December 25, then we as an auditor are safe. All right, we said that they are going concern, okay, it's already safe. But now it's not enough. If the approval of account is June 25, then the company has to last until 26 June. Then the going concern is satisfied. Then this is a very important point. That means as an auditor, the going concern doesn't cover 12 months from year end. It covers 12 months from the approval date. All right. So we have to assure that the company will not collapse from the day of approval, from 12 months from the day of approval. And this is very important. All right. So to allow us to have more assurance that the company will not close down in the next 12 months after the approval of financial statement, the auditor has to expand our audit procedure. All right, to cover, to evaluate and examine management method and assumption. All right, and we have to ask the management whether any update, event, and news to make sure that the company will continue for the next 12 months after the approval day. All right, and then separate reporting. The auditor also need in the audit report a separate paragraph addressing whether the company has going concern. Now, this actually adds a lot of burden on the auditor. The auditor has to assure to the reader, oh, the company will not close down the next 12 months from the day of this signing report. Actually, the economy is so bad. We are very uncertain. All right. So if it means that if the auditor has any concern about the going concern, you may need to qualify the going concern. But once you qualify the going concern, the financial statement cannot be prepared on the going concern basis. All right. And you have to, all the asset has to be stay at the recoverable amount and cannot be amortized, depreciated cost. You have to stay at recoverable amount. And you need to emphasize the need for those the communication between the auditor and the TCWG. What is TCWG? Management. Those charged with governance, that means management. The auditor and management need to have a good communication to make sure the company has a long-term going concern before you can issue a clean report. All right, and you also enhance the audit integrity about reinforce the skepticism. That means that auditor, we should be very skeptical. We should be very suspicious. Okay, whether it will be going continue the company, whether the sales is true or not, whether the account receivable can we receive it back. So this actually put more burden on the auditor and also reinforce them. They have to be more evaluated. You have to evaluate whether the management's assertion is correct or not. As a management assertion, the management need to claim whether it's a going concern. We have to take a look and then be more careful whether they claim whether the account receivable can be collected or the inventory can be sold. We have to be more careful before we conclude that the company is a going concern. All right. And the last part is actually very straightforward, a very new audit standard. There's a new audit standard coming called International Standard on Auditing for Less Complex Entity. Now, this actually is a good news to the auditor. Many companies, put it this way, all the audit rules are very complex. And sometimes large companies need to apply all this very complex audit rule. But the less complex entity, LCE, we call it, the account standard, the audit standard said that if the company satisfied as a less complex entity, as an auditor, you only need to do less audit work. All right, you can reduce your audit work. All right, so it's a good news. You can document less simple, much simpler. You don't need to do so many audit work, so much audit check. So, but this less complex entity would not apply to the foreign company. First of all, if the government prohibits some company, if the government do not allow, say that this company is not less complex entity, you cannot use the audit standard for less complex entity, LCE. Listed company definitely cannot use LCE. If a company is a deposit taking deposit from the public, that means similar to bank. You get money from the public, you cannot use LCE. Insurance company cannot use LCE. Or if you use component auditor, you cannot LCE. Component auditor means it's a group. For example, it's a group company. You have a parent company, and then there are a component in the audit, component auditor in the Cambodia, so that the audit of the parent company cannot use LCE because part of the group, all right, one of the subsidiary or a few of subsidiary is not audited by the parent company, not audited by the auditor of the parent company. Give you an example. The parent company is audited by PwC, for example. The parent company, I have a client like that. The parent company is Italy. The Italy parent company is audited by PwC. But the Italy company has a subsidiary in Hong Kong. And Hong Kong company is not audited by PwC. It's audited by a local CPA firm. All right? In that case, the parent company in Italy cannot be LCE because part of the subsidiary is not audited by PwC. It's using a component auditor. Understand? In other words, if it is a group, some of the component is not audited by the same auditor, then the group cannot be applying LCE. All right? Okay. So now this auditing standard is actually simpler because now it is not yet effective. This will only be effective in 1st January 2027. 27, far away. All right, not 26. Therefore, we will go into it only when there is effective. And basically, it's the audit standard rather than accounting standard. It focuses on the simpler standard, simpler documentation. It only focuses on risky area, those high risk area, that's low risk. Those areas that are lower risk, no need to do anything. All right. And it is actually more clearer and only enhance those small. It is a framework. You know, the standard only have 156 pages, 156 pages. So it's very thin. The whole standard. All right, it's very thin. Imagine the audit standard is very long, right? So the whole standard is very thin. So when it is effective, I would say it's a good news to auditor, especially those handling LCE. All right? Okay, I finished with all the material. Let's look at the question. So some people ask me some question. Let's take a look, all right? I would like to clarify about ISA 57, this one, all right? This. Okay, about going concern. If audit report has going concern, the asset of the financial statement is stay at recoverable amount, not amortized basis. Absolutely correct. Okay, do you see the question? You guys see the question, right? Let me. Okay, I pose the question here again. Everybody see the question, all right? She asked a very good question. Now, this is very important. If a company has going concern problem, it means that will close down very soon. In that case, all asset has to be stay at recoverable amount. What is mean by recoverable amount? That means how much you can get back the money. For example, give you an example. I have a machine. The machine is 10,000, depreciate 10 years. Then after 2 years, the machine should be 8,000, right? That is the depreciated cost. 10,000, 10 years. Now, 2 years gone. So 8 years to go. So 8,000. Now, this is not recoverable amount. This is depreciated cost, right? After depreciation. Now, if the company has going concern issue, then the machine cannot be stay at depreciated cost. You should ask yourself, if I sell the machine in the market, how much I can get back? If the machine, when you sell it, because it's second hand, the market only sell it at 2,000. 2,000 is the recoverable amount. Then the machine has to write down to 2,000. Understand? What about financial asset? All right. If I have, okay, 2,000 is the recoverable amount. What if some people ask me, if the machine cannot be like a computer, If a computer cannot be sold out because nobody buys second-hand computer, then the recovery amount will be zero. Therefore, all the asset may be written off to zero. Therefore, if the company has a going concern problem, it is devastating. It is devastating. Devastating means terrible, right? All the asset, a lot of the asset has to be written off. Imagine inventory, all right? If the company has going concern, that means the company closed down very soon. The inventory has to be sold very soon. You cannot sell it gradually, right? Because the company closed down, then immediately all the inventory sold. If you are the buyer, you know the company is closing down. Will you pay a good price? You know that they are closing down, they have no money, or they desperately need the money. You will pay you will offer a very low price to buy the inventory, right? So all the inventory will stay at lower cost, net realizable value. Okay. Now, inventory we talk about, PPE we talk about. How about financial asset? Now, account receivable, no more amortized cost. They stay at the recoverable amount. All right. How much you can get back from the debtor? Okay, I have a client who has an insurance policy. You know what's insurance policy, right? The company pay an insurance, which is investment. The insurance policy will mature in 5 years' time. That means in 5 years' time, you get back the principal plus interest. All right. However, the company now has going concern issue. That means the company is going to close down in the next 12 months. If you get back the insurance before maturity, the value is very small. Understand? All right. Therefore, the insurance policy, if you wait until 5 years' time, when you mature, you get back the principal plus the interest. But if you have to stay at recovery amount, that means you assume you get back the money next year. The amount can be very, very small. All right. Therefore, the insurance policy cannot stay at amortized cost. It has to be stay at recoverable amount. Correct. To answer this, Miss Do Shuk Lam, all right? The answer is yes. If the company is going to concern problem, all the asset, not just financial asset, has to stay at recovery amount. So in this case, auditor has to obtain evaluation report to calculate the asset, to disclose the asset as recovery amount. I would say yes and no, depending on whether you need an evaluation report on the asset. Now, some of the asset, like for example, building, maybe you need an evaluation. But some of the asset, like insurance policy, you have a surrender value, right? You check the surrender value. If I surrender today, what will be the value? All right, you use that amount as the recovery amount. All right, so the auditor is not forced, not compelled to get an evaluation report. It's up to you, but you need to assess what will be the recovery amount. Okay, because when the company is no longer going concern, the financial balance sheet, the financial statement cannot be measured at amortized accrual basis, not accrual basis, it's recoverable basis. Understand? So you assume the company is closed down. How much you can get back the money from the asset? All right, just imagine if you close down the company, how much the asset you can get back minus the liability. That is the asset value. That is the value of the company. Okay, so very good question. If this audit standard 570 going concern is actually extending the requirement that you have to assure the company not closing down in the next 12 months after the reporting date, the day signing the audit report, not after the balance sheet day. This is very scary. All right? It's very scary, honestly. Sometimes, some of my clients, December 23, all right? Now it's December 25. They still have not yet prepared the audit for December 23. But if I do the audit, December 24, they have not closed. They definitely have no going concern problem, right? Now we cannot, because it is from the day of signing the audit account. Okay, so we have to assure the user that this company is not going to close down from the day of signing the report, the next 12 months from the day of signing the report. All right, so it's very, very demanding, put it this way. Okay, let's take a look. Okay, 1 p.m. Bingo. All right, time's up. Any other questions? Any other questions? If not, then I have covered all the slide. And if you have any questions, please feel free to let me know. And thank you and see you next time. I pass back the time to the organizer.
Okay, so thank you, Ms. Eunice, for your insightful presentations. And all participants, I appreciate your times and engagement for today's sessions. And after you leave, please take a moment to complete the survey form that I will send via email. So once again, thank you for your participation. Thank
Thank
you.
you. Bye-bye.